Hello, everyone, and a very warm welcome. Today, we're stepping right into the ultimate masterclass on IND AS 16, Property, Plants, and Equipment. You know, whether you're a student, a young professional, or just someone who really wants to decode the financial language of businesses, you are in the exact right place. So, let's get straight to it. Here is a question for you. Did you know that the heavy machinery in your factory, the delivery trucks out there on the road, and even the building you are sitting in right now, they all follow very specific, strict accounting rules? Just take a second to let that sink in. Today, we're going to extract those exact rules straight from the standard, step by step, so you can understand exactly how businesses account for their biggest physical investments. All right, here is our roadmap for this explainer. We'll be looking at 1. Objective, scope, and definitions. 2. Recognition and initial measurement. 3. Measurement after recognition. 4. Depreciation and impairment. 5. Derecognition and disclosures, and finally 6, a master recap with some really handy hacks. Let's set a strong foundation and kick things off with Section 1, Objective, Scope, and Definitions. Now, the standard actually says, and I quote, "The objective of this standard is to prescribe the accounting treatment for property, plant, and equipment so that users of the financial statements can discern information about an entity's investment." Okay, what does that mean in plain English? It simply exists so that investors and shareholders can see exactly what physical assets a company owns and how the value of those assets changes over time. It is all about total transparency. So while IND AS 16 applies to almost all property, plant, and equipment, we definitely must know what is excluded from its scope. It does not cover assets held for sale, exploration assets, or mineral rights. It also explicitly excludes most biological assets, which are basically living plants and animals. But listen carefully to this part. There is a major exception for bearer plants. A bearer plant, like a beautiful tea estate in Assam that produces tea leaves year after year, is actually covered under IND AS 16. However, the agricultural produce on it, meaning the tea leaves themselves, are not. Right, so what exactly is property, plant, and equipment? Well, the standard defines them as tangible items, things you can physically touch. They must be held for use in producing goods, supplying services, renting to others, or for administrative purposes. And crucially, they must be expected to be used for more than one accounting period. Think of a massive textile mill in Gujarat or a huge fleet of delivery trucks. Oh, and 2 other quick terms you must know. Carrying amount is simply the asset's cost minus any accumulated depreciation, and recoverable amount is the higher of an asset's fair value, less cost to sell, and its value in use. We are going to use these terms a lot, so keep them in mind. Okay, let's dive into this next crucial phase, Section 2, Recognition and Initial Measurement. You know, you cannot just recognize any random item as an asset. It has to pass 2 strict tests. Step 1, it is probable that future economic benefits will flow to the entity. Step 2, the cost of the item can be measured reliably. Let me give you a brilliant example straight from the standard. Imagine a chemical manufacturer installs some highly expensive new environmental safety equipment. Does this equipment directly produce chemicals or increase revenue? No, it doesn't. But without it, the factory is legally not allowed to operate. Because it enables the factory to continue making those future profits, it definitely gives future economic benefits. So, it is recognized as an asset. Simple, Hannah. Once we recognize it, we have to measure the asset at its cost. But what actually goes into that cost? You include the purchase price, any import duties, site preparation, installation, and even the estimated future cost of dismantling the asset. But please look closely at the excluded costs. You never include the costs of opening a new facility, advertising, or staff training. Now, this is where most students go wrong. Listen carefully. Never, ever capitalize general administration overheads. Those belong straight in the profit and loss statement as an expense. Now, what happens after the asset is up and running? You'll naturally have subsequent costs. The rule here is very logical. Day-to-day servicing, like daily labor and small spare parts, well, that's just repairs and maintenance. You expense it immediately in profit or loss. But if you are doing a major replacement, let's say relining a massive furnace, completely replacing the interior walls of a building, or conducting a mandatory major aircraft inspection, you capitalize that cost. You add it to the asset's carrying amount, provided it meets our 2 recognition criteria, of course. Oh, and you absolutely must derecognize the cost of the old part that's being replaced. And this brilliantly illustrates a very specific rule regarding incidental operations. Let us understand this step by step.
Sometimes, while constructing an asset, you might earn some side income. For example, maybe you use an empty building site as a paid car park until the actual construction starts. The standard is very clear on this. This income and any related expenses must go to profit or loss. You cannot deduct this incidental income from the cost of the self-constructed asset. You have to keep them completely separate.
Moving along the timeline to Section 3, Measurement after Initial Recognition. The asset is on the books. How do we value it year after year?
Well, you have two choices here, the cost model or the revaluation model. The cost model is super simple. You just carry the asset at its original cost minus accumulated depreciation and any impairment losses. Alternatively, the revaluation model allows you to carry the asset at its fair value minus subsequent depreciation. Now, this is very important. Please note carefully. If you choose the revaluation model and you revalue one asset, you absolutely must revalue the entire class of assets it belongs to. If you revalue one single delivery truck, you must revalue all motor vehicles in that specific class. You cannot selectively cherry-pick only the assets that have magically gone up in value.
Before we jump ahead, we literally cannot ignore the appendices attached to the standard. Let's cover them exhaustively. Appendix A deals with decommissioning liabilities. Basically, if your initial estimate for dismantling the asset changes later on, that change actually adjusts the cost of the related asset itself. Then we have Appendix B, which is specifically for the mining industry. In surface mines, companies dig away a lot of waste just to reach the ore. This is called stripping. If this stripping activity improves future access to the ore body, those costs are capitalized as a stripping activity asset.
Let's transition into Section 4, Depreciation and Impairment. This is all about how the asset's value is consumed over time. Ooh, this one is a classic favorite exam topic, component accounting. The standard mandates that each part of an item with a cost that is significant relative to the total cost, well, it must be depreciated separately. Think of a commercial airplane. The main airframe might have a useful life of, say, 20 years, but those massive jet engines might need replacing every 5 years. Because the engines have a significant cost and a completely different useful life, you must separate them and depreciate the airframe and the engines individually.
Okay, let's do a rapid-fire round of the depreciation rules you absolutely must memorize. You can use straight line, diminishing balance, or units of production methods. But hear me out. You must never base depreciation on the revenue generated by the asset. Revenue is affected by things like prices and inflation, not just the physical consumption of the asset. You also must review the useful life, residual value, and depreciation method at least every single financial year end. Also, keep in mind, depreciation starts the exact moment the asset is available for use in the location and condition intended. It does not stop just because the asset is sitting idle. And finally, land generally has an unlimited useful life, so we do not depreciate land. Now, sometimes things go wrong, right? Assets lose value unexpectedly. They get impaired. For testing impairment, IND AS 16 just points us straight over to IND AS 36. But here is a very key rule from our current standard. If an asset is lost or impaired, and an insurance company or a third party gives you compensation, that compensation goes directly into profit or loss when it becomes receivable. Purchasing a replacement asset later down the line is a completely separate economic event, and it's accounted for as a brand new asset. Moving to the end of the asset's journey, Section 5, Derecognition and Disclosures. How do we remove it, and what do we tell the shareholders? You derecognize or basically remove the asset from the books either when you dispose of it or when absolutely no future economic benefits are expected from its use or disposal. To calculate your gain or loss, you simply take the net disposal proceeds and subtract the asset's carrying amount. Now, this is where most students go wrong. Listen carefully. The resulting gain or loss is recognized in the profit or loss statement, yes, but a gain on sale is never classified as operational revenue. It's a separate gain altogether. Finally, the standard demands total transparency through disclosures. You literally have to tell the users of the financial statements your measurement bases, the depreciation methods you used, and the useful lives of your assets. You must present the gross carrying amount alongside the accumulated depreciation. And most importantly, you must provide a full reconciliation showing additions, disposals, revaluations, and impairments over the year. Investors need this reconciliation to understand exactly where the money went. Oh, and you also have to disclose if any assets are pledged as security for bank loans. All right, bring the energy up. It is time for Section 6, Master Recap and Hacks. Let's lock this knowledge into your memory forever. I want you to take these cheat codes directly to your exam. For recognition, remember PEFB,
probable economic future benefits. If it doesn't have PEFB, it's simply not an asset. For initial measurement cost, remember PID, purchase price, installation, and dismantling estimates. For depreciation methods, remember SDU, straight line, diminishing balance, units of production. And the golden rule of revaluation, if you revalue one asset, you must revalue the entire class. Write these mnemonics on your question paper the exact moment you sit down, and I promise you will not make mistakes.
And just like that, we have officially conquered IND AS 16. So the next time you see a massive factory or even a simple delivery truck, I want you to ask yourself, what is the true hidden cost carrying that business forward? If this explainer really helped you understand property, plant, and equipment clearly, please hit that like button right now, share it with your classmates and your CA friends, and make sure you subscribe so you never miss a standard explained this simply. Comment down below and tell me exactly which standard you want me to decode for you next. Until then, keep learning and keep growing.